Hello everyone, I am Rahul sir, your management educator. A warm welcome to Global Online Platform. As you know, we have started the crash course on most important topics of management. So here we are discussing the financial management unit number 5. Before this video, we have discussed two topics, that is introduction to financial management and capital betting. Today we are here to discuss the most important topic, dividend theories. Dividend theories are very important from the exam point of view. So we are going to discuss, and after watching this video, you will have no doubt regarding any concept related to dividend theories. Okay, let's start. Before starting, there is an important information for you that the UGC NET exam is very close. We are offering the UGC NET Management Paper 2 course. If you take this course, you will get full syllabus lecture, full syllabus video lectures, full syllabus notes, test series, and PYQ PDFs. This is going to be your target-based preparation as the exam is very close. The biggest advantage of this course is paper 2 is course. If you take, you will get the paper 1 totally free. The fees of this course is 7,000 rupees and the validity of the course is 1,000 rupees only. Okay, so what you have to do, this is our official app, Global Online app. You have to download this. After that, when you log in to it, you will see this home interface. In this home interface, click on this second button, the store button. Here both the options are available. You can search in the search bar or just select the fourth course which is available here, that is UGC NET Management. After paying this fees, you can access the free n number of times the content which we have provided from all the units, all videos and different PDFs, study notes, or everything is available. It's the best time to take the advantage of all these things. If you want to join the batch and you have any query regarding the batch, you can contact on the given number through WhatsApp only. So in today's lecture, we are going to discuss what is dividend, what are the different types of dividend, what is dividend policy and its type, and for the main topic, dividend theories and models. Okay, so let's understand what's dividend. Dividend, if you see this word carefully, the dividend, what it means, divide in the end. Okay, so what actually dividend means? Ki whenever a firm earns profit, a certain portion of the profit is distributed among the shareholders. That we say that it's the dividend which is being distributed among the shareholders. Okay, so let's understand. A dividend is the distribution of part of the company's earnings to class of its shareholders as determined by the company board of directors. How much dividend have to give by the company will give, how much portion of earning will be distributed, this is decided by the board of the directors of the company. The decision to pay the dividend is based on the amount of after-tax profit. This point is most important, that the after-tax profit will be distributed, not directly the EBIT will be distributed. As we had discussed yesterday, suppose if this is your operating profit, earning before interest and tax, EBIT. So what we will do, suppose if it's your earning, this involves all the three things. One second. This is your main earning. So it involves, it means that is earning before depreciation, interest and tax. Here what you will minus, first you minus the depreciation. Then you will get the EBIT, earning before interest and tax. Then you will lose the, reduce the interest. Then you will get the EBT, earning before tax. Then you will reduce the tax and you will finally get the earning after taxes. The portion of this EAT, earning after tax, will be distributed among the dividends. Sorry, among the shareholders. Okay, the portion of this EAT will be divided, not the EBIT, because EBIT includes all the interest and taxes which the company has to pay after earning the profit. So after deduction of the interest, tax and depreciation, the EAT, the portion of EAT will be distributed as dividend. I hope this concept is clear. Let's see what are the different types of dividends are available. So cash dividend, stock dividend, scrip dividend, property dividend, share repurchase, and liquidating dividend. These are some the types of dividends which we generally use by a company. Okay. So let's understand from here. I hope this is clearly visible. So let's see cash dividend. Cash dividend is the most commonly used type of dividend. This dividend is commonly used here. The dividend is paid in the form of cash. As per the terms, the company pays the dividend in terms of cash. Okay. Then second comes bonus share. Bonus share is also used by the company. Here it is a company issues issues a surplus share when they have low operating cost. When they have low operating cash, shareholders receive additional shares from the company side. So this is about this bonus share. Bonus share means extra shares will be given to the shareholders instead of the cash dividend. Okay. Then share repurchase. Share repurchase means buyback of the own shares by the company. Here, in case of share repurchase, as the name suggests, repurchase, the company buybacks its own share. Then reduce the number of the shares outstanding. Whatever the shares are outstanding, the company reduce its figure by taking them back from the shareholders. Okay. Then property dividend. Property dividend is the payment made in the form of assets. Instead of cash, instead of any share, a company pays makes the dividend available in the form of an asset. So this is property dividend, and the value of the asset is restated as per the time of payment. The value of the asset will be restated at the time of payment from the company side. Property dividend is generally not practiced in our India. Okay. Very few companies use this type of dividend. Otherwise, mostly cash and bonus dividends are paid. Next comes scrip dividend. Scrip dividend, in case of scrip dividend, a promissory note to pay that the dividend will be paid later is given from the company to the shareholders. Okay. It is used when there is a hard crunch, where the company's earning is not enough, and so they provide a promissory note where it is clearly mentioned that the dividend will be paid later. Okay. Let's understand the liquidating dividend. Here the liquidating means liquidating dividend means return of the original capital dividend. So as a dividend, the company, whatever the amount the shareholder has given at the initial period, the company returns his original capital, and as a dividend, instead of dividend, they return whatever the investor has invested in the beginning in the company, whatever was the original capital of company. So liquidating dividend, as the name suggests, here the company's position is getting worse and it is going to end its life. So this dividend is seen as a sign of closing of the company. Whenever a company closes, it uses the liquidating dividend to return the original capital as a dividend. I hope all these types may be clear to you. So let's understand what is dividend policy. Now we had seen the types of dividend. Now here comes dividend policy. So a company's dividend policy dictates that the amount of the dividend paid out by the company to its shareholders and the frequency with which the dividends are paid out. So here we see, in case of a dividend policy, that how much what is the amount of the dividend is we see, and what is the amount of the dividend we have to pay, and how frequently the dividend will be given. This is decided in the dividend policy. Okay, when a company makes the profit, they need to make the decision on what to do with it. Whenever a company makes a profit, they have to take the decision what to do with it. They can either retain the profits in the company, retain in the form of retained earnings on the balance sheet, or they can distribute the money to the shareholders in the form of dividends. Either they will retain the money which they have earned, or they will be distributed as they will distribute it as a dividend. Okay, let me tell you here on this slide. So what actually it means. So here the company ABC, it has made a profit of 10 lakhs rupees. Now it has both the choices. It may retain this whole 10 lakhs, or it will distribute in form of dividend. Let's understand what will be the consequences if the company retains or if it distributes. Suppose if a company has to expand its own business, it will retain the earning. No, the dividend will not be paid. But if a company has to attract the future, in future to that the investor should come and invest in the company and become the shareholders. So at this time, the dividend will be distributed so that the market position of the company will improve in the marketplace. Okay. The position of the company, the goodwill of the company matters a lot in a market. So it will only be enhanced by distributing the dividend, not retaining the dividend. Okay. So suppose there are a company does not pay dividend for a longer time. So the positions that people feel people don't like to invest in such company, but which a company is giving dividend at regular time intervals for a specific amount is decided and it is being given from a long time, the goodwill of the company will be high as compared to company which is not paying dividend regularly. Okay, so let's discuss the dividend policies. We have 4 dividend policies: regular, stable dividend policy, irregular dividend, and no dividend. These are the 4 types of dividend policies which we have to understand. Let's understand one by one. So what is the stable dividend policy? A stable dividend policy is the easiest and the most commonly used. If it's asked in the exam that which type of dividend policy is easiest and most commonly used, mark the stable dividend. Okay, the goal of this policy is steady and predictable dividend payout each year. Every pre-decided amount will be paid every year in the form of stable, in case of stable dividend policy, which is what the most investors seek, which is what the investor, whether the earnings are up or down, the investors receive the dividend. It does not matter what the company is earning in that particular financial year. The company will have to pay the fixed dividend which it has at regular intervals, which has decided as per the stable dividend policy. Okay, either company earns in lakhs or loses in thousands or loses 10,000, the company will have to give the dividend in case of dividend policy anyhow. Okay, in case of stable dividend policy. Then we have regular dividend policy. In this type of dividend policy, profit distribution to the shareholders is made at the usual rate at regular time interval. Here the usual rate and at regular time intervals, the dividend will be distributed as per the regular dividend policy. It's very simple. Then irregular, it's just opposite of regular dividend policy. In this type of dividend policy, companies don't pay dividend regularly. Companies don't pay dividend regularly due to various reasons. There are certain reasons where the company is not paying the dividend regularly, such as the liquidity. Liquidity means the conversion of the product into cash, sales into cash. Then volatility in the future earnings, there is some company is feeling some fidelity that what will be its future earning, etc. And in fact, the companies following the dividend strategy are exactly opposite in the nature of the company, which is with regular dividend policy. The position of the company who is using the irregular dividend policy will not be much better rather than a company who is using the regular dividend policy. The goodwill of the company of this company, whosoever is using the regular dividend policy, will be better as compared to the company using irregular dividend policy. Okay, they don't have the history of stable earnings. The company here, keep this point in mind, the company whose stable earnings are not there, they uses this type of policy, that is irregular dividend policy. Okay, then last comes no dividend policy. As the word suggests, that here not a dividends are not paid. Okay, the type of dividend distribution policy is this type of distribution policy is followed by the company that requires the capital for funding attractive future growth and opportunities, or to support the liquidity stretch due to unfavorable working condition position. Here, what does it try? It's trying to say that the future, that the no dividend policy will be adopted by the companies which wants to grow in the future, and they have good opportunities, and they have to support the liquidity stretch whatever they are facing, and they have their working capital which is used to perform the day-to-day operations is very less. They have to bring the working capital position in a favorable form. These companies do not pay any dividend. Okay, here any sort of dividend is not provided to the shareholders. So this point is very simple. In case of no dividend will be paid neither regularly nor in a specific amount. Okay, I hope these four types are clear. Let's understand the main thing, that is dividend policies, dividend models, and dividend theories. All these things, either they mention policy, whether they mention model or they mention theories, this is the everything same. So dividend policies or the dividend theories are generally categorized into two parts. Two main parts are there. One is irrelevant theory and another is relevance theory. The irrelevance theory, what does it mean? That if the dividend you give, it will affect your, it will not be in case of the relevant. In case of relevant dividend policy, if you pay the dividend, it will affect your value of the firm. Okay. But in case of this irrelevant dividend policy, the dividend being paid has an independent effect, has no effect on the value of the firm. Okay. So here in case of irrelevant policy, we have only one theory, that is Modi ji. Not Modi ji, our PM Modi, jokes apart, but here the Modi Galani Miller is the we have to study in dividend irrelevant theory, and in case of relevant theory we have to study GW. Okay, that is Walter model and Gordon model. Okay, we have to study in case of dividend relevant theory, and in case of irrelevant theory we have to study the Modigliani and Miller hypothesis. Let's understand one by one. Let's understand the Walter model. Walter. Okay. Jokes apart. So this model was given by James C. Walter. James C. Walter, remember this name? The Walter model was given by the person named Walter who eats a lot of James, which we used to eat when we were in child position. In our childhood, we have ate a lot. So it's Walter model was given by James C. Walter, that it's the relevant model of dividend. It's a relevant model of dividend. This is also you need to remember. And dividend affects the value of the firm. What did Walter say? That he said that the whatever dividend the firm will pay, it will have a direct impact on the value of the firm. If dividend is paid, the value of firm will increase or vice versa. Suppose if a company pays the dividend, its value will increase, but in case a company who is not paying dividend will not have any impact on the its value will decrease. Okay, let's understand this point once again. When the company who is paying the dividend will have a positive impact on the value of the firm, but the company who is not paying the dividend have a negative impact on its value of the firm. It highlights the relation between R and K. R and K, R we have discussed yesterday, that is internal rate of return, and K we have discussed. K means the cost of capital, that is internal rate of return are and cost of capital are the two major aspects which are being studied in case of Walter model. Okay, then IRR is the internal rate of return and K is the cost of the capital. Okay, then it is also called share valuation model. This name also keep this mind in name, because sometimes the examiner changes the name and asks the question. So Walter model is also named as share valuation model. Okay, so all these things normally, in case of always remember what will be asked from these theories and these topics. Number one, it's assumption, most important. Then who is the developer? Okay, then the formula. Okay, and then any sort of relation or condition. Just these are the four things which you have to remember. That is assumption, who is the developer, then what is the formula he has given, and what is the relation or the conditions, and what type of dividend will be paid. Let's understand the condition relations in Walter model. Before that, let's study the assumptions of Walter model. Assumptions are specifically most important of the Modigliani-Miller model. Every time they have asked. Okay, but we need to keep in mind all the assumptions of the different dividend model and the capital structure theories which we have, and the CAPM, APT, and Henry Markov's risk analysis model. These are the most important models of which the assumptions of which models should be on our tips. Then only we will able to score marks from such type of questions. Okay, then let's understand the Walter model. Walter model says that the all financing done by the retained earnings, no external financing will be used. He said that whatever financing we need to do, we will do by using the retained earning. No external debt will be used. Okay, means no external financing will be used. Then business risk is constant. Here the business risk will be constant. Then IRR and K means the internal rate of return and cost of capital will be constant. Fourth point says that the company has indefinite perpetual life. Suppose if in place of the indefinite you see definite in exam, that statement will be totally incorrect. So remember, a company's life is indefinite as per Walter model. Okay, then earnings of the firm are either distributed or reinvested. Suppose here the word reinvestment also means that retained. Okay, then the earnings of the whether either the company's earnings will be distributed as a part of as a dividend, or the earnings will be reinvestment for the future growth. Anything can happen. It was the assumption by James C. Walter. Okay, then the EPS and DPS does not change. It will be constant. The earning per share or the dividend per share will be constant, and there will be no taxes. This assumption is totally common in case of any type of dividend theories, that there will no taxes will exist. So let's recall in quick. Let's make a quick recall. In case of Walter model, the financing will be done through retained earnings. No external sources will be used. Then business risk will be constant. IRR and cost of capital will be constant. EPS and DPS does not change. Then no tax exists. Then earning of the firms are either distributed or reinvested, and company has an indefinite perpetual life. I hope now the assumptions will be, you will not forget. So let's understand the three conditions which happens in which is seen in the Walter model. So here a firm has passes through three stages, that is growth firm, decline firm, and normal firm. In case of decline firm, in case of growth firm, the internal rate of return will be greater than the cost of capital. And here the correlation between the market price of the share and the size of the dividend will be negative. So you have to remember this as it is. And what will be the decision? That the 0% payout, no dividend will be paid. In this, the first case where the return is maximum greater than the cost of capital, here 0% payout will be there, means no dividend will be paid. Then in case of decline firm where the company is losing, so making losses. So in this case, the return is less than the cost of capital. The internal rate of return will be less than the cost of capital. Here there is a positive correlation between the market price of the share and size of the dividend. This will be positive correlation, and 100% payout will be there. The principle behind the 100% payout is that company is not getting much money, not earning much money. So she pays the dividend so that they can attract the shareholders in future to invest in that company, by which they can get some funds. Okay. So this is the motto behind the 100% payout in case of decline firm. Okay. I am telling this because such type of things can be asked in the assertion reason type questions. Okay. Then in case of normal firm, in normal firms, the R and K have equal. They are both are independent. Internal rate of return is equal to the cost of capital. Here no correlation is there, and the decision optimum payout will be there. Okay. I hope this chart is clear. Here all the conditions are mentioned. Let's understand the mathematical representation formula by Walter. Walter has given a mathematical model for the above made statements, whatever assumption he made here. So the formula is P is equal to D upon KE plus R by KE, E minus D upon KE. Okay. So this formula, if you write once or twice or thrice, you will keep in mind. Okay. What does P indicates? P indicates the market price of share. Then D indicates the dividend per share. R is the rate of return on the firm's investment. K is the cost of equity, and E is the earning per share. Okay. Let me check. Just here is some. No, that's only the correct formula. Here, what has happened, that the equity financing, they have internal financing will be used. Na? So in the retained earning is also mention of the in form of equity. So KE represents the cost of equity, E is equal to earning per share, then R is equal to rate of return on the firm's investment, D is the dividend per share, and P is the market price per share. Okay. So I hope this Walter model is clear to you. Then let's understand the Gordon model. Gordon model was quite similar to the little bit similar to the Walter model, but here there is a minute difference. The Gordon model given by Myron J. Gordon also supports the doctrine of the dividends are relevant to the share prices. It is also says that if a company pays dividend, it has a positive impact on the it has a certain impact on the value of the firm. Here the dividend capitalization model is used to study the effects of the dividend policy on the stock price of the firm. Here what this model is has the another name, that is dividend capitalization model. A certain capitalization rate will be used to understand that what is the impact of the dividend policy on a stock price of a firm. This is the main difference between the Walter and the Gordon model. Then this is also known as dividend discount model. Gordon model is also known as dividend discount model, means just have a three names. GDC. Okay. GDC means this is Gordon model, then this is dividend discount model, and this is dividend capitalization model. So just GDC, who has given a person who has wear a maroon color shirt has given. and was sitting in the garden. That is Meron J. Gordon. In this way, you can understand the name of the author who has given all the three models, that is GDC, Gordon model, dividend discount model, and the capitalization model. Okay, then let's see the next point. It is used to determine the intrinsic value at the stock. Intrinsic value of the share is determined at a given rate. Okay, then this is a relevant approach and also called bird in hand theory. So the Gordon model is also called as bird in hand theory. So you have to remember here four things. What? G, B, C, and D. GBCD means generally, let me tell you the mnemonic how to remember this, because these are the different names of this model which may be asked in change and it may confuse you. So see, generally the capacity of CD is in MB, but here the capacity of the CDs in case of Gordon model is in GB. Okay, then here again the same thing I am repeating again and again so that you should remember this. That is capitalization model, discount model, Gordon model, and bird in hand theory. So this is the whole concept of this CDGB. Okay. So it is also called as bird in hand theory. Let's understand the assumptions. Assumptions we have to keep in mind as it is. Gordon model has based on the following assumptions. The firm is an equity firm. In case of that Gordon, in case of Walter, the financing was done by the retained earnings. But in case of this Gordon model, the whole equity financing will be done. Okay. Then there is no external financing available. There is no external financing available. Then the internal rate of return of the firm is constant. Constant IRR will be there. Then the appropriate discount rate K of the firm remains constant. Here it is repeating the same things, that the IRR and K will be constant. Okay. Then the firm and its stream of earnings are perpetual. It simply means that the life of the firm is the indefinite. Okay. Then the corporate taxes do not exist. There are no taxes, no corporate tax exists, and the retention ratio B, once decided upon, is constant. Thus, the growth rate G is equal to BR is constant forever. This is the main additional assumption provided by Meron J. Gordon in his model, that the retention ratio, which is denoted by B, and what is the formula for B? G is equal to BR. Gabbar, you remember, it will be helpful because G for retention growth rate and G has the formula BR, and BR. Here the B is not B. Here the BR is not that BR which people used to have in bar. Jokes apart, but here the B is the retention ratio. So remember, whenever we talk about the Gordon model, remember Mr. Gabbar. Okay. Then K is equal to BR is equal to G. It has a condition is not fulfilled. If this condition is not fulfilled, we cannot get the meaningful value of the share. If the K is greater than BR, the cost of capital is greater than BR and it is equal to G. If this condition is not fulfilled, the value of the firm, the meaningful value of the firm will not be determined. Let me tell you in differently. So here I am writing, this condition is very much required to be met successfully. That is K is equal to 9. 1 second. That the cost of capital should be greater than the retention ratio and it should be equal to growth rate. If this condition meets, we can say that the value of the stock can be easily determined. Okay. This condition is very much necessary to be met to determine the meaningful value of a stock. So let's understand the quick, let's take a quick glance of the assumptions of Walter model, as they are very much important. It is based on all financing is done through equity mode. Then External financing is not done. No external financing is done. IRR and K both are constant. Then firm has a perpetual life. Then no tax exists, and the retention ratio B and the retention ratio is constant, and thus the growth rate G is equal to BR. Gabbar is also constant forever. Okay, G is equal to BR is K is greater than BR is equal to G. If this condition not met, the value can be meaningful value of the stock cannot be determined. So these are all the assumptions of Gordon model. Let's understand the reason behind bird in hand theory. Why the theory is this? Why this model is called as bird in hand? Investors are rational. There are certain reasons behind this, that the investors are rational. Then investors are risk averse. Risk averse means they don't like to take the risks. So here the investors are risk averse. They don't want any risk, and the future, they think that the future is uncertain in case of amount and timing. In case of the future, in case of the amount and timings, the future is uncertain. So what an investor thinks, that whatever we are getting, we should take it right now. It doesn't matter whether the price is high or not. The price is not the concern. Whatever we are getting, we should get it now. So the last line is most important. Investors prefer the current dividend rather than the higher dividend at the future. Okay. Here it is not present. This point is future. So last point I will repeat once again. So investor prefers the current dividend rather than the higher dividend in future. Okay. Suppose, for example, if a person is getting the share price at 110 rupees, so he will buy. Instead of buying a share which cost 90s, and in future he will get a dividend of rupees 50 on it. So instead of this, if he will buy the share which price has rupees 110, and the dividend currently being paid is only 20 rupees. So he will pay the premium price, but takes the dividend which is offer at this time, because they don't want to take risk in case of future benefit. Let's understand the formula given by Meron J. Gordon. P is equal to EI 1 minus B divided by K minus BR. Okay. So P is the price per share, K is the cost of capital, EI is equal to earning per share, then B is the retention ratio, and 1 minus B is the payout ratio. Okay. So G is equal to BR, growth rate, R is equal to internal rate of return. Okay. So Gabbar, you remember, G is growth rate, B is retention ratio, and 1 minus B is the payout ratio. Okay. I hope this model is clear to you. Then Modigliani-Miller dividend theory. Let's understand this. It is most important from the exam point of view. It was given by Franco Modigliani and James Miller. It is the irrelevance theory of dividend. This theory was earlier Walter and Gordon were relevant theories, but this is the irrelevant theory. Then the dividend policy does not impact the value of the firm. The value of the firm is independent of the dividend policy of the firm. Okay, the value of firm is affected by the investment policy of the firm. This point is very much important. Who will impact the value of the firm? The investment policy will impact the value of the firm rather than the dividend policy. Okay, this point you should keep in mind, that the value of the firm will be affected by investment policy, not by the dividend policy, because these are some confusing points which you should have unless you have a thorough understanding, you may get confused while attempting such questions in exam. So always remember that firm has an impact of firm, the value of the firm will be affected by investment policy, not by the dividend policy. Okay. Then investors do not check the dividend history. Investors do not pay attention what type of dividend are being paid in the past trend. So the last point come, market price of share does not affected by the dividend. Whatever the dividend is being paid, the MPS market price of share will not be influenced. Let's understand the assumptions of Modigliani-Miller model, dividend theory. So perfect capital market exists. It's the common assumption that the perfect capital market will exist in case of either it is capital structure or it is dividend theory. The Modigliani-Miller has said that the perfect capital market will exist, which is in reality, it's just a myth. Then here the investors are rational. Here the no transaction cost are there. Then the free to access the information, investor are free to access. Then no large investor influence the market securities. Low large investor influence the market securities. Then no taxes. Assumption 2, no taxes. Then third is the investment policy is not changed by the company. The investment policy will be constant as it's not changed by the company, and investors are certain about the future market price and the dividend. Here they have given a major assumption. He has given a major assumption that investors will be know in advance what will be the future market price and what will be the dividend they will get. So this model was the irrelevant model, but its assumption are most important. Many times they have asked question from this, specifically the assumptions. All the three models which we have discussed, mainly the assumptions and formulas are important. Let's see the formula of Modigliani-Miller model. So here P0 is equal to D1 plus P1 divided by 1 plus KE. In bracket 1 plus K whole divided by 1 plus KE. Okay. Then P0 is the prevailing market price of the share. K0 is the cost of equity. K is the cost of equity capital. D1 is the dividend to be received at the end of the period 1. And P1 is the market price of the share at the end of the period 1. So this is all about the dividend policy, dividend theories, which we have studied. All this topic is very much important from the exam point of view. Just there are only three models which we have to study, that Gordon, Walter, and what is that? And this Modigliani-Miller model. Their assumptions are very important and their formulas are very important, and developers. I have told earlier, these three things, if you keep in mind, you will easily can attempt any type of questions asked from these dividend theories accurately. So that's all for today. We will meet in next video. Till now, bye. Thank you. If you like the video, just hit the like button.